A word of thanks to the panelists sitting beside me for accepting the offer to join us and share their insights into an ever-evolving market here in the GCC and beyond. We believe that your expertise is valuable to share and welcome you on stage. Ankur, this question is for you. I would like to first start the discussion on the current state of the equity markets here in the region. It would be great if we could get a general assessment of equity markets here in the Gulf and the catalysts determined to be the drivers of performance for 2024 and beyond.
Yeah, thank you, Faisal, and good morning, everybody. So if we see the history a little bit, since last 4 years, Gulf markets have done reasonably well. The total return has been at around 35%. And if we compare this with the emerging markets as reflected by the MSCI EM index, the returns are negative 10%. And if we compare this with the developed market X, America, the returns are at 28%. So as you can see that Gulf beyond Aramco have done really well since Aramco listing. So what's going forward? So we can divide this thing into two time frames. One is 2024 and looking beyond, let's say, 2024. So in 2024, the markets are likely to be driven by more cyclical factors, like interest rates, for example, or geopolitics, or other factors like oil prices. Why is that? Because in our region, around 60 to 70% of the markets are reflected by banking sector, hydrocarbon sector. So those drivers are likely to remain interest rates and oil prices. Now, if we go beyond that, that's where the story lies, in our opinion. And we remain very positive and constructive on the GCC markets as we go beyond 2024 to, let's say, to the end of this decade. There are many structural things are taking place in the Gulf. And we see two pillars in the Gulf region. One is the non-oil GDP growth, and the second thing is the energy transition. So for example, if we focus on non-oil GDP growth, if we see the forecasts, also as discussed with our esteemed panelist, the non-oil GDP growth is likely to be at around 3.5% to 4% compared to flat GDP growth. So we are seeing a big transformation happening in the Gulf region on the non-oil GDP side. Like if you see some data, now the non-oil GDP revenue is around 20% of a government's budget. And that number used to be 10% in, let's say, 2000s and 2010s. So it's a big transformational shift in our view. So these two factors are likely to be flowing into the stock market as we go. And this is driven by many things, including tourism, development of real estate, integration of the region in terms of trade, etc. Now, if we focus on the non-hydrocarbon GDP, which is non-oil also, which is an interesting classification, we have energy transition theme happening here, which means this part of the world will no longer be oil exporter. We are seeing this region as an energy exporter. Why? Because the countries like Saudi Arabia, for example, or the UAE to some extent, they do have immense potential in terms of generating sustainable energy by way of solar or, let's say, by way of green hydrogen, etc. And that's the energy of the future. So if we mix these two themes, let's say 5 years from now, what we are seeing, its impact on the stock market. So it's even more amplified because now we have three pillars which will be driving the stock market: oil sector, non-oil sector, and energy transition theme. So you must be wondering, why oil sector? So as we discussed in the last panel, actually, there was a lot of emphasis on privatization of economy in order to increase efficiency, in order to develop the whole regional markets. So oil sector is likely to remain the backbone for the equity market. And we have seen that happening in Aramco, for example. We have seen in Abu Dhabi happening in ADNOC. So that backbone is likely to remain. We are seeing a lot of activity in Oman for OQ, for that matter.
On that specific subject, maybe I could turn the question to Mazen, with regards to, would you care to comment on the Saudi vision to non-oil attribution to GDP? Are we seeing material success on that front?
I'd like to thank Kamco Investment for inviting me, and my second home, Kuwait, where actually I could consider my family. I have a great souvenir here. Back to your question about the vision, I think the catalyst in the Saudi market was based in the vision. And if you look 10 years ago, been covering the Saudi market for more than 14 years, was the catalyst Saudi market or the correlation with oil as actually you could say above 0.7. That's very high. Was more actually to petrochemical and banking sector, which actually the major till now, but they were actually creating the majority of earning, and government spending was correlated with oil, which moving other sector. Now we're seeing after the vision, a new sector are pushing this, the market drivers. For example, logistic, for example, renewable energy, for example, building construction with the number of Arab possible to come. And would like to add that in Saudi Arabia, the Expo is adding expectation that the number of shortage of room might reach 60,000, between 60 to 80,000 rooms need to build in Riyadh. The Giga project being done, might be done by the PIF in the coming 5-6 years. So if you look to the stocks that's exposed to those sectors, actually had will perform and create alpha. Your number of stocks, Saudi market have a 328 stock. Number of stocks had to create alpha in the beginning, exceeding the index, beginning of the year about 110. Either last year, number of stocks were 110, but with the different factors. If you allow me, Faisal, to go back to Naif, to go to and comment on either on the market valuation and market catalyst. First of all, we can't ignore that we're experiencing a difficult year since 2018 till now with China under pressure and United States with a higher interest rate. And this is adding bigger pressure on valuation. This is the most important factor, which is
We've seen spikes, and consequently, we've seen deterioration in performance because of these spikes in valuation.
Yeah, but to me, I consider market as the best economist, to me. Now, if you look to the Russell index in the United States as actually performing, and the 10 years bond in the United States are discounted. The yield went up to 4.7, it had fell to 3.9, and back again to 4.7. But Russell actually had well performed. It's actually Russell 2000 for growth stocks has actually well performed. What that does mean, this correlation between them both. Market is expecting the cut will happen. And if we look to the inflation indicator, if we exclude the sheltering, we'll find actually the core inflation is close to 2%. But sheltering, and the way they calculate it, is quite lagging 6 months. So if we check to the current indexes of sheltering, as for example, Zillow index, we will find it's actually all fall back to normal. So I think inflation is in the way to fall down. But the issue, I think, with the Fed, is the labor force is still strong in the United States, and the employment is still low. It's not actually, it's falling down to 3.7. Number actually of retail consumption is still strong. And the Fed members never experienced a situation like that. Some of them waiting, and they don't want to do the cut earlier. They want to be sure that inflation will fall and the labor force won't push the inflation back again up. So if things get good, they can do the cut. If inflation is resilient, it's still interest rates are up. Yeah, and it's a decision they never been to it, and always the Fed saying,
on that,
yeah. So them waiting, but the market is believing, and I'm actually with the market. The cut will happen, but it was early to think it will happen in March. Most possible to happen in June. Number of cuts were taken at Al-Rajhi. Actually, we took it 3 number of cuts. Possible to exceed 3 to be 4 or 5. It's very possible. But the possibility to do the cut in March is very low, and I believe this was over-optimist. China, if we look to the other side, I will look to the...
But you mentioned something important. Yeah. You mentioned the word correlation. As we know historically, we've always been correlated to oil prices, and I think the recent geopolitical events demonstrated something a little bit different. Although oil spiked, we tended to go down. I think, Abdullah, you had a very good comment with regards to that.
Right. Right after October 7th, we saw a bit of a pullback in terms of valuations, a bit of a dive locally and regionally.
While oil prices did go up.
Oil prices did go up, but there was kind of, I think, that's when we see the flows for foreign investors and other, there was a knee-jerk reaction in terms of the market valuations, especially, that's when all of a sudden, geopolitical risk comes top of mind to those types of investors, because the formula, their thesis, especially to active investors for active foreign investors in the markets, have that kind of reaction. But since then, there's been a comeback, and actually very strongly performed locally, even regionally as well, and has pulled back beyond that, and much higher levels than we even saw last year, in terms of especially the momentum trading volumes.
And then on the subject of interest rates, let's assume interest rates were cut. Will we expect regional central banks to follow suit? And if so, which sectors will benefit? Which sectors will not? Looking at it from a macro picture, we all assume that the banking sector will not benefit, given that they borrow on a short term and lend on a long term. But from previous discussions with you, I think you had another insight or another point of view to this matter.
Well, I believe that central banks will follow the Fed. Whatever they cut, they will reduce it. Despite, we're now seeing the LIBOR as a spread is the highest historically, usually to be 25 basis points, now at about 70 basis points. So already is high. So the more they cut, and I remember once they made the 22, they raised the Fed, they raised the yield 50%, Saudi Arabia raised it, the SAMA only 25. The minimum they keep it spread between LIBOR and SIBOR is about 30 basis points, 30 to 25. We still have a 70. So that means the more they cut, they will follow it. The spread is high between LIBOR and SIBOR. And majority of central banks are following our pitch to dollar, or have a big exposure to dollar and then currency basket. So it's clear that they will follow it. What are the sector? Majority of sector, we're seeing the market, and I'll talk about my specialty, the small and medium companies in Saudi market are leveraged, and they will benefit. The cost to earning of financial cost is ranging between some companies between 10 to 35% in this level, small to medium. So this will add to the bottom line. And I think this is one of the reasons market is optimist with the cut, beyond the growth happening with companies that will reflect in the bottom line. So this is a major factor. And in 23, we did not see a big effect of oil as we saw it as interest rate. In Q2, oil prices was under pressure. At WI fell down below 70. Brent was 73, was before implementing OPEC agreement too. And it was one of the good, quarters for the Saudi market. The performance had reached the peak, middle of July. When oil price according to our calculation, between $90 to $70, market will react neutral with oil for a reason. According to our calculation, Saudi budget is based on $80, with the earning revenue of the total budget about 64%. So $80 with a production between 9 to 9.5, that's enough to Saudi government to reach them target with a deficit about a range 80 billion riyal. Keep in mind that if it is either below 80, the effect won't be severe for two reasons. There is a dividend, stable dividend, the government have it, and the performance dividend that had added recently, and that fixed it. Second, that the debt to GDP in Saudi Arabia is still low, to 26%. They have a room to take it up to exceed 30%. So we think still $70 as a bottom, the market won't react negatively with oil, and vice versa, till 90 either, upside.
Ankur, do you have a comment on that front?
Yeah, maybe I can just add on the interest rate front that currently we are in a real positive rate environment where your interest rates are higher than the inflation. And these environments are not that great for the investment growth because the cost of money is high. But nonetheless, we continue to see, as Mazen mentioned, the rate cut, and which should continue to even more, I would say, kickstart the investment cycle. And in terms of stocks, I would like to add that what has happened that due to higher rates, the earnings yield and dividend yield of the economy has dropped below the bond yields. So people would rather make safer money in bonds rather than investing in equities. So as rates go down, we would continue to see money moving back to the equity market. And that should certainly help the market dynamics. And I would just like to add one more thing, that in this environment also the high dividend paying stocks generally tend to do well, and which has been one of the strength points of the region. Because if you see our markets are yielding at around 3.5 to 4% in terms of dividend yield, which is one of the highest globally. So definitely in these positive economic conditions, reduction in rates, which is not really driven by any fear of, let's say, inflation, is likely to remain very positive in our view.
Abdullah, there's a heavy subject that's been mentioned multiple times during today's presentations, which is the attention of foreign investors to the region, considering the inclusion to emerging market indices. Have we succeeded in attracting foreign capital to our capital markets? Being specific is fine, whether country specific or sector specific.
Yeah, of course, we see that very prominently across the region. In Saudi Arabia, attraction of FDIs, in the UAE, across the whole region. Even in Kuwait, we've seen it. If you look even in the public markets, as you said, the emergence to emerging market indices. And we see the banks, in Kuwait, for example, MBK, almost a quarter of the holders, the shareholders of the bank are foreign investors. So I think that's worked. And it's attracted both the index investors, the passive investors, as well as active investors. And not only do we see that in the public equity markets, we also see that in debt markets, as Ankur mentioned, their rates being so high, good quality issuers because of the sovereign ratings where they are in the region. There's a good opportunity to selectively invest in high yielding, high credit rating debt opportunities. And we even see it in the movement of hedge funds, as well as private equity and venture capital investors moving to the region, because as we've heard earlier today as well, and as everyone knows, this is sort of the one of the highest growing regions in the world. There's a lot of opportunities, and there's a lot of benefits for international investors coming into the region. So we see that across the board.
Yeah, it's being more of a conducive environment for international institutions to operate from. Question to you, Mazen. Has the recent spike in IPOs being offered affected the liquidity in the listed market in any way?
We did not see that fiction, as I mentioned a while ago, that the big exposure to the old economy in Saudi market is still high, above 45%. And if you add petrochemical and banking, and consist more than 45. For that, you see so many, the breadth of market, so many small companies are beating the market, where the market itself is limited. And to 2023, the Saudi market had rallied about 14%, where there is companies, about 110 companies had made above 20% in the Saudi market. The reason is the big weight for banking and petrochemical. So adding more companies that are diversified and correlated either with the vision, as for example, Aqua Power that had made about almost 300% since IPO, benefiting from the major giga project in Saudi Arabia and renewable energy, plus either ICT companies as Elm, Solutions, Tubi, adding other companies related to infrastructure in Saudi Arabia as Marafiq. All of that has creating diversification. And we think this has had new factors to the Saudi market, reducing the correlation with oil, adding more correlation with the consumption, with the coming project, and enhancing the sentiment in the Saudi market. But end of the day, we could say that the major factor always market is the interest rate, and never fight the Fed. We write it on the wall every day. We read it. Never forget.
In terms of infrastructure spending, this question is for you, Abdullah. In terms of infrastructure spending, it just hit a new record in the MENA region in 2023. Where have we seen the most, and where have we seen the least, and why? The why is the most important part, obviously.
Last year was a very active year in terms of projects awarded across the region. It's actually a record-breaking year across MENA in terms of total projects awarded. We saw it around, over 150 plus billion dollars in projects awarded. That was the record in. Actually, that was the record, I think, in 2014. Last year was over 180 or something like that. In Kuwait, it was, almost triple 22. 22 was the lowest year across the region in terms of projects being awarded. But in Qatar, they're around $20 billion, and that's post-World Cup. And the UAE, $80 billion. In Saudi Arabia, around $100 billion of projects awarded, and that's obviously across all sectors. Oil and gas and services were a big beneficiary of that, but also, as Mazen mentioned, infrastructure, etc. So it was a very active year, and I think there's many reasons led to that. One of them is a lag effect post-COVID. So we're catching up with key infrastructure spending that's needed to both for maintenance, but as well as growth, especially for these new projects that are linking the whole region together. Yeah.
I'd like to shift our focus to Kuwait specifically now. We anticipate the introduction of new corporate taxes in Kuwait. How do you envisage these taxes to affect the market, and what have we learned from our Saudi neighbors who recently went through that experience? Yeah?
There's the saying that says, the only certainties in life are death and taxes. But one of them doesn't apply here in Kuwait. Mostly, I mean, we have currently between zakat, national labor support tax, and the kefas, it's around 5%, which we can label that as tax. Of course, it's much lower than international standards and regional as well. I think with the introduction of the new tax scheme that over 140 countries have signed off on, started as an initiative with the G20 and OECD. I think, you can't avoid the application of corporate taxes because of other countries taking the taxes that should have been applied to Kuwaiti companies that are operating in those countries outside Kuwait. So it's going to happen eventually, sooner rather than later. I think the first estimate is for it to happen in 2025. It's going to take some time. Anyway, this is obviously going to have a lot of ramifications. Tax means lower net profits. But I think, and as we saw in Saudi Arabia, what happened was there's an effect on valuations, but also inflation went up. So that's something that has to be done, in a very calculated manner.
A gradual manner is what you're
very
saying.
calculated. Obviously, there's many moving parts to this that are affected by changes, that are not happening locally. So it's a wait and see. We're going to see how this plays out, but of course it's going to have tremendous effects. However, that being said, if we see more projects, more business, more growth, more project development, the economic engine moving, as they say, a rising tide lifts all ships. I think there's going to be less focus, less importance for taxes. If there's, net, everyone's making more money in the economy.
Gentlemen to his right and left, do you care to comment? What have we learned from the Saudi experiment going through this over the last few years?
We start with me?
We can start with you.
Okay. When we start in Saudi Arabia, the VAT, one major important ideas is to give a government exposure to the private sector. VAT is sort of taxation that it is easy to be collected. And one of the major obstacles globally that it's difficult to collect the tax. Where the VAT was simple one, it started in Saudi Arabia in 2018. And had helped the government to understand what happened in the private sector. And since then, the shadow economy either had sized down. Considering the emerging countries' shadow economy of GDP 27%. An advanced economy about 11%. This is the range. I think that had helped Saudi Arabia a lot to understand and try to help the private sector. That started in 2018. In 20, Saudi Arabia had increased the VAT from 5 to 15, and that had helped the Saudi government to reduce the deficit in 25, and either the credit rating of Saudi Arabia. And credit rating was actually well appreciated from the global rating agency. The Saudi reforms had happened and the fiscal policy. And that had helped us. And the amount of debt Saudi Arabia issued, we used to be zero to GDP debt. Zero in 2015. Now we're about 26%. When credit rating is an investment grade in Saudi Arabia across the three major rating agency, and still Saudi Arabia one of the lowest, from the lowest nation among the emergent countries. And thanks to this, managing the policy and spending and either creating a new revenue apart of oil.
Ankur, would you care to comment on that?
Yeah, I totally agree with Abdullah and Mazen on this point. They have covered, I think, most of the points. Maybe I can just throw a little light on the impact on the equities. So if we see our forecasts, we will definitely deduct, let's say, 10% taxes from the net profit of the company, and which is generally negative in that sense.
However, we over that negativity after so many years?
Sorry?
Are we over that negativity, that negative impact to corporate earnings? Has it been assumed right now, and investors and analysts do consider it as a part of life from now on?
Exactly. That I totally agree. And other thing is that, Faisal, is as the government is trying to diversify their revenue resources, they are getting a little bit more decoupled from the oil revenue, which means that whenever we are inputting in our model the cost of equity, so that number will be a little bit more robust and less volatile. So at the end of the day, if we see the bigger picture, better finances at the macro level, at the country level, means relatively better valuation for the at the corporate level. So it's kind of, I would say, win-win situation from other angle as an equity shareholder.
Well, my final question focuses on Kuwait. And again, this is a subject I had the good chance of discussing with you, Abdullah. So, and I honestly, I would appreciate your insight in this manner. It seems that we had a few IPOs in the planning for Kuwaiti companies that have since been abandoned. Would you care to add a comment on this? Is it because of the state of the market, the state of the economy, regulations?
Yeah. Of course, all of those factors weigh heavily on the decision of a company to go public or not. It's not an easy process going public. You only do it once, so it has to be, the best time for a company to go public. And I think with the various factors that were happening the last few years, the valuations, lower trading volumes, etc. Especially, in Kuwait, a lot of the companies, they're private companies, they're family-owned, family-controlled companies. They've decided to sort of adopt a wait-and-see attitude to the markets. They're ready. They're sitting on the sidelines, waiting to jump in when the right opportunity happens. Inshallah, it will be soon.
I promise, one more question. With regards to the supply of debt instruments, will we expect to see a lot more in the GCC, in Kuwait specifically? Is it an opportune time? Obviously, when interest rates do come down and stabilize a little bit, why haven't we seen a further supply of that come into the market, given that they're more favorable than their global counterparts?
Maybe I'll just speak a little bit and let Mazen add more color, especially in Saudi. It's a lot more active market. But just briefly, in Kuwait, I think what's holding us back is the lack of government debt issuances. There's no benchmark, there's no national curve, etc. But that being said, the banks, because of Basel III and various regulatory aspects, are very active issuers of debt instruments, and they tap the market for various even capital instruments as well as senior unsecured funding. So that's kind of you're limited to the number of banks in the market. but we haven't seen many private issuers of debt. However, that being said, the market in UAE and Saudi Arabia is a lot more diversified, a lot more active. You have smaller issuers, SMEs, government, government institutions tapping the market. Maybe I'll let Mazen add some color about that.
Okay, thank you, Abdullah. We'll start actually with taxation and subsidies, and then we'll go to the debt in Saudi Arabia. When taxation has started and subsidy cutting, we were worried that might hit actually the Saudi market and make a deep discount. And we discovered now that's push companies to adapt to new business models. And the retail companies, some of them had creating financial arms to lend actually micro lending for them clients, and it was very successful. We saw some Saudi either consumption has been changed with this new entertainment or new cultural services has been open with the vision. So this had changed the Saudi basket. It was not actually, the purchasing power no doubt has been affected per person, but the total purchasing of the economy had to grow because of the labor force and either the generation, if you look to the Saudi labor force, the age, demography had changed. The age 55 and above had reduced by far, and age about between 25 and 35 has increased, and they have other way of consumption. So that actually had changed actually the demand and the market. So we observed so many companies has benefit either despite the VAT. And other companies, the models has improved with the VAT when they add the financial lending. Back again to this is about, and either subsidy, we found companies, they improve them efficiency. They try to improve. Either companies, they try to make them prices to avoid price war between them each other when they saw cost of inputs has come in, has increased. That has organized the market. Other side, you're talking about the debt and rising debt and the market was actually source of lending was not tapped. Saudi Arabia was 90% of banks actually generating cash from deposits, where an average globally is 70%, where debt and bonds is a source. For that in Saudi Arabia, when you look to loan to debt between banks, arithmetically you'll find it above 100%. But if you go to the formula, adding the bonds or adding the duration of lending, the maturity of lending and deposit, you'll find it below 90%, the average between banks. So this is new tools. The government tried to add it, a part of the classic or conventional tools, I could say, to add a new instrument and a new investment, product, financial products as a bond or a short-term investment in the market that wasn't there. And we observed recently the fixed income weight in a market, despite higher interest rate that make it less attractive recently. And when interest rate is up, the correlation between financial assets become high and they actually depreciate together. And if you look to the MSCI bond and equity market together were down end of 22 because of higher interest rate. But we observe the market again is back again, coming back. The investment of fixed income is increasing in Saudi Arabia as a volume. Beyond, is there an equity?
Well, we see the introduction of derivatives and
Sorry,
regional
but
equity
just
markets.
before that,
Please.
I think before we go, I think what's really, really interesting to observe, just to follow up on that point, is the sophistication and the speed of the development of the fixed income market in Saudi Arabia.
Yep.
Tapping not only local issuances, which is very active in Saudi Riyal, but also dollar issuances where even the government institutions are tapping markets for very long durations. For example, PIF went beyond the Saudi curve, the sovereign curve, issuing debt at 40 years and even 100-year paper that's paying a fixed rate of 6.25%. So that really amplifies the ability of the government to fund its project, to fund itself, to fund the vision, and diversify its funding sources and tap into pockets from all around the world. I think that's really a smart way of supporting and financing the vision and its goals.
Actually, I concur with that. Till now, it's more the government. More lending, more issuance. If you check to it, about 70% is more to now government. It's not the private sector. So we see upside, big upside in this market that the private sector did not yet actually add issuance to the market.
With regards to the introduction of new financial instruments and derivatives, building on that point, do you anticipate it adding unhealthy volatility to the market, or will it even out?
I'm sorry. Can you repeat the question?
The introduction of new financial instruments and derivatives into the Saudi market specifically as well. So
Well,
the
I'll
ability
make it-
to short
I'll
and
make it
the
short
likes.
because I believe our colleagues are a little bit.
We have about 2 minutes left.
I'll make it short. It's a new in Saudi market, but it's a great indicator to understand the economy. We observe two different markets, the Indian market and the Taiwanese market. It's been years that the paper market was amount is less than 1% relative to the cash market. It's been years. But now in India, it's 4 times multiple the size of cash market. And in Taiwan is about 70% of the cash market. It will take time. Till now, it's this small number of stocks that they have issued derivatives. We think it will take time, but it's a very healthy to make the market more efficient for a reason and make it a real leading indicator for the economy.
Ankur?
Yeah, I would totally agree with Mazen's view. These instruments would definitely improve the efficiency of the markets. Like we have seen some volatility on some of the names, which are driven by excessive speculation because there are no mechanism to short. So the stocks could continue to go up without any fundamental basis. So by introduction of these derivatives in a structured manner, in a controlled manner, would definitely be beneficial for the long-term growth, integration of these markets to the global markets, in our opinion.
And also, if I may add, risk management, right?
Yeah.
Exposure, the ability to hedge, the ability to lock in prices and manage risk in many, many different ways. It's a key part of sophisticated markets, and at the end of the day, while there is certain amounts of speculation that happens naturally, it's a very important way to manage risk and strengthen the market overall.
Panelists, thank you for your insights. Audience, thank you for your patience and for your time.
Thank you.
Thank you.
Thank you.
Our next panel will explore the real estate investments, particularly through the lens of private debt. I would like to welcome Mr. Hassan Farran, Chief Executive Officer of Kamco Invest London, who will be moderating the discussion between Mr. Borja Dietlanos, Global Head of Alternatives at Santander Asset Management, Mr. Mark Feliciano, Global Head of Real Estate for Private Markets at Manulife Investment Management, and Mr. Mohammed AlOthman, Executive Director of Alternative Investments at Kamco Invest.
Thank you, guys. I'm delighted to host this panel discussion titled "Navigating the Dynamic Landscape of Real Estate Investment Through Private Debt." And although the title suggests a focus on private debt, it's hard to discuss that without touching upon real estate investment in general, and especially as we have this wonderful panel of experts with us, traveling from the US and from Europe, and also from Kuwait, of course. Unfortunately, there is no time for questions, so if you have questions, please grab us in the break, and we'll answer any questions you may have in relation to the subject we've discussed today. So let's start by looking back a little bit. We're in 2024. The past 3 years can easily be described as adjectives as turbulent, uncertain, extraordinary, and even unprecedented. Mark, let me start with you. Looking back over the past few years, what are your observations you've made with regards to corporate real estate?
Great, thank you. And thank you everyone for the invitation, Kamco and Burgan Bank. Can you hear me? Yep.
Yes.
Great, thank you. Well, I think the theme of this conference is really congruent with what we've been seeing in the real estate market globally, but particularly in the United States. A lot of change, a lot of transformation. Obviously, we've all been impacted by what could be viewed as paradigm shifts in how we use real estate. We're no longer really looking at real estate simply as sectors like multifamily, office, or industrial, et cetera. We really look at how we use it. So, for example, live, that includes multifamily, single-family rentals, That includes student housing. When you think about manage, that includes industrial outdoor space, including truck terminals, et cetera. And then when you come to innovate, that's where it gets a little more interesting, again, congruent with some of the themes around education and where innovation hubs are located, but those include data centers, life sciences, et cetera. Then work. Work, obviously, office and medical office, that's gone through a significant transformation. But then you also just look at what we call secure and procure. So industrial, for example, and retail, that falls into how we use or how we secure and procure. So we've been looking at really how do we use real estate, really in terms of determining where to invest. But I think what we're seeing over the next few years relative to what's transpired in the last few years is really a wave of debt maturities that's really against the backdrop of repricing, essentially, both in terms of the appraisal market, but also what we call spot transaction markets. And you do that against the backdrop of what we heard earlier today, which was, I think, 76 of the 195 countries are going through an election in which every single voter has the right to cast a ballot. So not only will interest rate policy be at the forefront, but tax and fiscal policy will also be at the forefront. So when we look at the opportunities today relative to what's transpired, we think many of the huge opportunities across the globe, but particularly in the United States, are in the real estate credit market as we look to recapitalize broken capital structures and also fund what we call developments and other new opportunities.
Thank you. And just if you can touch upon how you see the change, for example, looking at offices. We're all working in offices, and I think the experience here in the Gulf has been quite different to what we've seen in the US. What have you seen on the office side and working in office?
Yep, so what we're seeing in the United States is a lot more acute on the negative side than what we're seeing in Europe as well as in Asia Pacific, where we've seen what we call higher utilization rate, meaning the employees of the tenants are occupying or going back to the office. In the United States, but it's helpful to put into context, there's about 4.8 billion square feet of what we call existing inventory. Only 10% of that, plus or minus, is what we call Class A stock. That Class A stock has been generating or been the benefit of what we call positive net absorption, about 160 million square feet relative to that 4.8 billion. All the rest has been what we call negative absorption. So demand has been waning. What we call Class B or non-Class A stock or second and third generation stock, that's been facing the most significant challenges. But again, the Class A stock is only 10% of the existing inventory. That means the other 90% has to get repriced. But we're beginning to see green shoots in the office space. And what I mean by that is big leases are coming back into demand as opposed to small leases. We're also seeing such a wide differential in terms of rents between what we call Class B and Class A, almost 100% rent differential. So those tenants who need to make an economic decision now face a real decision to make in terms of going to Class A, paying almost 80 and 100% more, or paying something significantly cheaper. That being said, we've seen space requirements go down anywhere from 15 to 25%. I think we are close to the trough of that. Many of the leases that were created or executed over a decade ago are renewing and also going through, again, the space reduction requirements that we've seen. We think we'll go through that phase another 2 or 3 years, and then what we call the operating market for office should start to stabilize.
Cool, thank you. Burgan, just turning to you now, and just similarly to my initial question to Mark, in terms of how you look at the European real estate market now, 3 years on from the pandemic starting in 2020. What are your thoughts on that?
Thank you, and thank you for having me. Pleasure to be here. The way I kind of try to think about it in my head is trying to separate assets from liabilities within the real estate and who is acting for what reasons, no? And try to frame it that way to try to understand what has happened, of the drastic change that has happened in real estate, no? So Mark pointed out basically that if you think about it from an asset perspective, there's been a drastic shift in terms of how we use real estate and for what purposes, no? Living has been a sector, obviously, that has radically transformed and is transforming itself from student housing to senior living, etc. Data centers obviously were here before the pandemic, but have exploded in terms of the megawatts or data needed for artificial intelligence and other means. And then we have the flip side, which is obviously offices, retails, etc. Obviously, these trends had started before COVID, but COVID has drastically accentuated. Obviously, real estate is very, say, locally driven, so it's very hard to generalize, but in general terms, that's what has happened in the asset side. So basically, some assets have been able to transfer the inflation increase into the rents. Obviously, offices created it's one good example, but many others have not. That basically means that their cap rate has not increased as it should, and that basically means from an asset perspective is less valuable, given that the cash flow that it's throwing is less valuable. No? From the liability side, you have the perfect storm, no? In terms of higher inflation, and then that higher inflation, which some assets couldn't transfer into increasing price, but that higher inflation was translated into higher rates. No? Think of real estate as an asset with a very long duration. No? We're talking before of 100-year bonds. No, well, real estate is kind of like a very long duration asset. No, and hence, if you increase the interest rates and you decrease basically the expected cash flows that you're going to receive through the present value of that increase in rates, it obviously translates into a negative, say, asset value. No, and then on top of the liability side, add to that what Mark was referring to, which is the wall of refinancings that has happened, but it is expected to happen over the next following years. No? In Europe alone, we have around, depending on who you ask, no, there is around 100 billion of refinancings per year, which compared to the States is a drop in the ocean, but for the European market is massive. No? And this adds to the third, say, variable that I was referring to, which is the actors within real estate. No? And the actors have drastically changed. Not so much on the equity, that has changed somewhat, but especially on the debt side. No? We've seen the problems of the regional banks in the United States with real estate. We've seen how many banks in Europe are retrenching, and we're faced with a situation in Europe whereby there's a massive amount of refinancings, but commercial banks are hardly lending. And that leaves a very nice space for the alternative lenders.
Thank you, and we're going to come back to that point. But let me ask you, given that you work for a bank, your thoughts on the health of the European corporate real estate lenders at the moment, because we're seeing a few articles coming out of the US and also more recently on Europe about some concern with regards to some of these banks having high exposure to real estate.
Definitely. First of all, I do work for a bank ultimately, but I do work in the asset management side, so it's a bit different. But having said that, what we've seen not only from our bank, but for many other banks, as I was saying, is basically a retrenching. Basically, they will only finance those assets that are core plus, with very stable cash flows and hardly any refurbishment or construction risk, if anything at all. No? Obviously, on the residential side, that's different because that's seen as lending to an individual buying a property. But on the commercial side, obviously, a severe, drastic change in terms of the risk appetite. No, I don't think. Personally, obviously, that's a personal view, but we'll have to see how 2024 and 2025 develops. That the commercial banks in Europe have had the severity and the problems of the regional banks in the States. That may be also because, as Mark was pointing out, the crisis in the real estate sector, especially, for example, offices in San Francisco and some other places, has been extremely severe. And to be honest, in Europe, obviously, there have been some areas of a lot of severity, but they haven't been as big as the ones in the US, I would say, in general.
Yes, so as an example, in the United States, we have $2.5 trillion US dollars of debt maturities over the next few years. But when you look at the bank market share of money center banks, regional banks, et cetera, it's been historically about 40% of the market. We expect that to stabilize right around 25 to 30%. That's congruent with what we saw with CMBS pre-GFC or the pre-Great Financial Crisis, where that was right around 30 to 35%, but is dropping to right around 10 to 15%. Due to the regulatory changes, including Basel 5.0, we expect that the banks to actually be a little tighter or more tight with the balance sheet lending in the context of real estate over the next few years. So there's going to be a huge funding gap, against a backdrop of lower valuation. So that's going to create huge opportunities, I think, in what we call the private real estate credit market. When you look at Asia Pacific, to put into balance to your question, getting away from banks, what we call private equity assets to private credit, it's about 31 times. So 31 times AUM for private equity relative to private credit. In the United States, that's about 5 times, and in Europe, that's about 4 times. So there's still huge opportunity in terms of market share for what we call private credit, and specifically private real estate credit, to gain in terms of compared to conduit lenders as well as bank lenders.
Thank you. Mohammed, turning to you. What's the perspective been? We've heard now about how we've seen it in the US and Europe, but from in the GCC, what has the perspective been relative to what we've just heard in terms of what's happened in the other parts of the world post-COVID?
Oh, sure. Okay. مساكم الله بالخير. I'd like to first thank Mark and Borja for being with us here. Hassan, to your point, I think that the investors that we have in this part of the world and the competition that is being formed currently in the region compared to what is available in terms of opportunities in the US and the UK. Prior to COVID, prior to 2020, there was ample of opportunity and capital to be deployed internationally. I think since then, there is a lot more that is happening in the region, specifically more so in GCC, and to drill down even more into Saudi, I think there are enough opportunities that would attract investors into the market. That's one, but the other thing, given the high interest rate environment that we have been going through, there is another competition from the local banks and the local deposits that can offer attractive returns given to in comparison to what we used to offer at what real estate used to offer prior to 2020. All that being said, but there is still opportunity that is in the international market and the mature market in the form in Europe and the US. And the correlation between what the investors and currencies in the GCC given to the dollar, that also makes it even also continue to make it attractive for investors to continue deploying cash into deploying capital into these markets.
Cool, thank you. And we'll come back to some of those deposits and the way forward, perhaps as well. Now, Borja, obviously the theme of this discussion is private debt, and it's been a very much talked about subject amongst investors and very popular. Why do you think that is? And secondly, where do you see, coming back to your earlier point, where do you see the opportunities in 2024 and 25 in this space?
Sure, thanks. Well, in general, with increasing rates, the relative value of private credit or credit in general vis-a-vis equities has obviously shifted. No? When you had interest rates that were zero, negative, or close to zero, obviously having a debt instrument that paid 2 to 3%, wasn't that attractive if you would try to make equity investments that taking favorable terms of that debt, we're able to get, say, double-digit returns. No? So it made a lot of sense prior to COVID, call it, to be on the equity side and on the debt side. That has shifted somewhat. The reason for that is, if you think about it from a company perspective, many instruments on the debt side pay significantly more than the expected equity returns, not only the dividend yield, but also in terms of overall returns. That is, also affecting the real estate market, as we said before. Think about it this way. You can do many private credit transactions in the real estate, whether it's Europe, the States, or other areas, where you can get high single digits for senior secure financing. The cap rates, i.e. the implied yield that property is paying, is still maybe on the 4 to 6%. So you're getting, say, for 50 to 60% loan to value, rates of anything of almost double what the cap rate, i.e. what the asset is yielding. So you're basically absorbing through the senior secure financing all basically the yield that the asset is producing. Okay, that basically means that the debt has significantly more value than the equity in general terms. No. When we look into the debt, obviously we are very much focused as well on sectors that have positive inflation. As we said before, you need to be, I think, in real estate on those sectors or in those niche areas that are able to transfer to the clients positive inflation. That we look at it into the debt side, but we also look at it into the equity side, as I guess we'll comment later on.
And in the context of the opportunities that we're seeing and the opportunities that you're seeing in the market today and you expect to see over the next 12 months, say, how does a falling interest rate environment affect that, and to what extent?
It's an opportunity, no? Definitely in the same way that higher interest rates affected negatively the asset value of real estate because of the duration of the asset. In a similar way, falling interest rates should affect positively, no? That's why trying to lock in right now financings with protections in terms of the refinancing risk that you're having is something very interesting, no? We're looking into some transactions just to, obviously on a no-name basis, but to mention some. We're looking into, for example, mezzanine financings on data centers where you're taking construction risk, but that construction risk is fully covered by, a turnkey contract with a proper construction company with a, very big market cap, which have triple net lease agreements with the likes of Amazon, Meta, Alphabet, etc. And you're getting, low teens return for that type of investment. Yeah. That investment is not going to be there for a long time. That will be refinanced, say, in 3-4 years' time. What you need to ensure is that you lock in a certain number of years at that rate in order to ensure that, the money multiple, i.e. the full effort that you made for that investment pays off, the transaction cost and basically working hard to find the transaction. No?
Thank you. Mark, we have spoken earlier, and you've been quite positive about 2024, and you specifically referred to the opportunity to disrupt the market. Can you elaborate on that a little bit?
Yep. Maybe by example. We're pretty positive in 2023 too, not just 24. In fact, I think we were one of the most active investors in 2023, and one of those examples is a construction mezz deal where we worked with Kamco as a partner. Again, an example of disintermediating what we see in the office space. So Chicago, which is arguably a tale of two cities. You have Central Loop and East Loop among the weakest submarkets in the country. But then you have Fulton Market, which is arguably statistically the hottest office market in the country, the hottest residential market in the country, and the hottest retail in the country. All the statistics suggest that it is so. That being said, it's a capital markets play. There's been a freeze in the capital markets. Many development sites for office and retail in the Fulton Market area, but they can't get capitalized. But as I mentioned, the Class A stock in general, particularly in Chicago, is 10% or less of the office space. And it's about 95 to 100% leased or occupied as well. So there really is no inventory for those tenants who want to move to Class A office. So the thesis that we had was to capitalize what we felt is actually the best corner in all of Fulton Market with a new developer, or with a developer and a sponsor that is pretty well known across the globe in terms of the equity financing. So it was a huge opportunity to capitalize what was what we call a shorter or thinner senior stack cut off at 37% and have a mezz stack roughly right around 75% cut off or detachment point. With economics where the current pay is 10% plus current yield and a total return of 17 to 18% gross returns. You can't really get that in the equity market today because, as I mentioned, we're still facing valuation declines. And I think the most important thing to note is by cutting off at 75%, you're at 2016 cost basis or development basis. So the question is, do we think there's any real basis risk through the mezz? Our answer is no. We don't think it's going back to 2016 trading prices or development basis. Maybe it goes back to 2019 at worst, but today we're proud to say that we're about 3 or 4 months from being nearly 100% leased based on the recent activity and conversation. So again, in a span of 6 months, as opposed to taking 3 to 4 years to lease up a new development for office, We're close to being fully leased in a span of 6 to 9 months at worst, simply because there's no inventory for Class A. And it's at fantastic returns that you can't really duplicate in the equity market, as Jorge noted. And then the other example is that we recapitalized a $1.2 billion industrial deal with a preeminent developer operator. I wouldn't say he or they were distressed, but they were stressed. Again, an opportunity to take advantage of what we call a sector with great secular demand through 2040 plus, and we structured that as what we call hard pref. So not quite debt, but what we call preferred equity. And again, total returns in the low 20s, and a pref return of, call it mid-teens as well. So another example of the opportunities that are out there today because of the wave of debt maturities against higher rates and a general repricing in the U.S. market.
Thank you. And Mohammed, in terms of, and I know that Kamco is actively pursuing opportunities both in the equity and the debt space on real estate. But from your point of view, what do you see being the biggest challenge from an investor's point of view in the GCC to tapping into these opportunities? And how are you managing to create a pathway for these investors?
Yeah, sure. I just want to also just mention also one thing about what Mark said and the opportunity in Fulton market. It is something that we are definitely, we believe in, and we definitely see the value of office, Class A office in areas like the US and Europe and the UK. In this part of the world, and you go east towards Asia and the rest, the work from home mentality or environment is not really prevalent as opposed to the US and the UK. But offices, Class A offices with the right amenities and in the right locations, they will always find occupiers. Which we have seen and experienced in the Fulton market that Mark has the opportunity that Mark has talked about, and we're very happy and glad to hear that they're almost done in terms of the leasing. So
is that new information?
Yeah. So that's fantastic news for us and for our investors. But to your point, Hassan, and the challenges that we have seen, that we are as a company operating in Kuwait and out of the GCC. Our client base are mainly in the GCC area. There are opportunities that are competing opportunities and investment instruments that are available in the market that compete with such returns that can be generated in the US or European markets. To the point of the earlier panel, our colleague Abdullah was talking about fixed income instruments and bond and sukuks that have been very active, and Kamco has been very active in it in the 2022 and 2023. And these are opportunities and instruments that our clients appreciate, and the investors in this part of the world appreciate and understand, because there is that element of liquidity in it that generates the good returns. There is the cash flow that comes with it, the quarterly, the predictable cash flow, which prior to 2020 and prior to the pandemic, real estate opportunities used to offer in the equity side. Generous return, decent return, generous returns, and with predictable liquidity. Now, fast forward to today, and what the market has shifted into opportunities in the debt space. The debt space is something that we at Kamco have been looking at for quite some time, since 2014 and 15. But at that time, where at the level of interest rate at that time did not generate enough or decent returns that would attract investors, because there were the good returns in the equity side. Now, in today's environment, we think that the debt can generate very good returns as high as the equity used to be, assuming a debt risk, which is a lower risk to the equity. So there is that segue, and that is that entry point into this market. And also to Borja's point, there is a short window depending on how long and when do we think interest rate will start to go down, and how will that impact the credit space. But there are good opportunities right now into that space that would generate returns But we need to seize the opportunity, because that window will be shut in the next 12 to 18 months, where things will turn around.
And from your point of view, do you, when you look at debt opportunities, do you have a preference whether they are operating assets, i.e. hospitality or student housing, or is there a preference towards long let product or development, or is that less important for you?
Right now, I think from what we've seen, there are sectors that we definitely are interested in. One of the hottest sectors are, to Borja's points, also is data centers. It is something very important that we can see, and we see that the long-term value creation that can happen there. But when it comes to other sectors, we're agnostic. We look at the opportunity. If it makes sense, we will definitely we'll look into it and drill down, and we'll definitely consider it.
And Borja, if I may ask you a similar question, from your point of view, as pursuing these opportunities in Europe, do you look at that aspect and what are the things that are key for you when you're assessing these deals?
So I fully agree with what Mohammed said, but I mean, on the debt side, we're much more opportunistic. So we may go into a situation or into an asset that may not be the one that I would buy from an equity perspective, but from a credit perspective, it does offer the security, the yield, the return, and also the likely exit, because when we lend, the last thing we want to do is to do a loan-to-own type of transaction and end up, enforcing and having to sell the asset. So the exit on a debt perspective, it is fundamental, So when you take all of that combined, on the debt side, we're seeing that opportunities not only on the, say, data centers or living sector, but also on the offices, retail, commercial centers, etc., that are very, very interesting. When we look into the equity side, we are much more focused on where we see a lot of value being created and a lot of opportunities, and there our focus is mainly on the living sector. So there's been a drastic change in the way living concept is happening in Europe, but especially in Southern Europe. The demographics around it are basically ones that the numbers, to the extent that we start looking a bit more into, say, the UK or the US, are increases of growth of more than 10, 20% even per year. So if you think about, for example, student housing, in Spain, there's only 7% of beds per student in Spain vis-a-vis in the UK, that it's around 30%, whereas Spain is a country that attracts a lot of students because of our history with universities and openness and what have you. So it is natural to think, and there's many projections, many studies, that number will significantly increase. So if you can capture that from an equity perspective, whilst not absorbing a lot of risk, you are likely to enter into a sector that is growing, that is booming, and are able to enter into, say, equity or asset yields, of around, almost 10% when you build the residence, and you can probably exit around 4 to 5%, and that with that yield compression on the exit is how you make, say, high teens returns. So that's the expectation.
Thank you. I think we're coming to the end of it. Thank you very much, panelists, for participating, and thank you very much, audience, for listening. As I said, if you have questions, please tap us up during the break and enjoy the rest of the conference.
Thank you.